Hello, welcome back to a weekly market recap here with Knight. Let's get to it. So this past week, we saw the market down 0.97%, brings us year to date 15.2% up in the S&P 500. And the big news this week, Tuesday, inflation CPI data got released, and a lot of weird things happened this week, so let's just get straight into it. We were actually hitting all-time highs at the beginning of the week, leading up even some intraday all-time highs. And then what we had on Tuesday, before the market opened, so on the 13th, we had the CPI data release, and it was actually higher than expected. We hit 0.9% month over month, which is the highest that we've hit since 2008. Really bad number. But what was surprising is we actually saw the market relatively shake it off until midday. And then for some reason, midday, we just started to see a big sell-off. All of a sudden, a big recovery at the open, as if the inflation numbers weren't that worrisome. And then from that high that we saw on Wednesday, we basically saw a sell-off, a little bit of a recovery at the start of Friday, and then basically a sell-off until the end. Now, something that was very curious is normally when we see inflation higher than expected, it goes along with the 10-year treasury. So the 10-year treasury tracks what are we expecting inflation to be over the next 10 years. So I'm going to jump to that chart. So this is the 10-year treasury chart. Again, the 13th. So we're looking at the 13th. The news came out prior to the market open, and we saw almost no reaction. We saw a little bit of a jump up, and then it settled back down. And then for some reason, midday, we just saw this big jump up again. But the surprising part is for the rest of the week, we've actually seen the 10-year treasury follow the same suit as the market and sell off. Now, one of the interesting pieces about if we were expecting inflation to come in higher, we would expect this chart to be going up. Another thing that this chart measures is the expected economic health in the future. So if we are expecting GDP to grow at a slower rate, we would actually start to see a lower yield as well, which is really what we saw. And that might be one of the fears long term. If we're seeing inflation coming higher than expected, but we're seeing the 10-year treasury drop lower, then that's not a very good sign for the underlying economic health. But enough dilly-dallying. Really, the whole storyline this week is about inflation. So let's get to the actual data. As we see, 0.9% rise in June on a month-over-month basis, higher than what we saw in May with a 0.6% rise. And one of the hopes was that we were going to see a de-acceleration of the increase. So we saw 0.8 all the way back in April. Then we saw 0.6 in May. We were hoping for something, 0.6, 0.5. Instead, we increased right back up to 0.9. The headline number over the past 12 months, 5.4%. Again, one of the highest increases that we've seen since 2008. Not a great comparison year when we're thinking about high inflation. One of the pieces that still is a huge factor is this 10.5% increase for used cars and trucks. Now, we've talked about this before. It's the travel, hotels, hospitality, used cars and trucks that we've seen just really leading the inflation charge. And as we see again, 1/3 of this increase at this time. Now, if we look at the past 12 months, we see exactly what we were doing, the month-over-month change. And really, just like I was saying, we saw this increase in inflation, and we knew we were experiencing inflation in February, March, April, May, but we were really hoping to see this start to trend downward. In May, if we saw in June, 0.5, it would have started to at least confirm the hypothesis that maybe this is transitory. Now, with a 0.9 month over month, it starts to beg the question, how many more really high readings like this can we expect and see until we have to stop saying that this is just transitory and maybe inflation is here for the long run? Now, on the counter argument, when we look at the pieces that are really driving this high number, they all do seem at this moment still relatively transitory. So let's go into some of the highest numbers. So what I'm looking for here is just where are the really, really high numbers, 10.5. Again, used cars and trucks. That is a transitory amount. We're not expecting used cars and trucks to rise at this rate for a long time after the chip shortage has been addressed with, after these large companies have stocked up inventory. So let's keep going. So let's look for the large numbers. So one thing that's interesting, this past month, we did see across the board a lot of meats increase at a higher rate than expected. So if we look, we have 5% for uncooked, 6% uncooked steaks, 6.4%. We see 5% down for pork chops. And again, this is on a month over month basis. So relatively large movements. But if we start looking at other food, we don't see the same type of movement. But this is one of the keys, that if we started to see inflation broaden out, not just in meats, not just in used cars and trucks, not just in hotels and hospitality, but if we start to see it broaden across the board, that's a bad sign that inflation really might be here to stay for the long run. Let's keep looking for some other high numbers. 3.5% on laundry equipment, 5% on women's dresses. Now that's one that did come in pretty high, is apparel. Transportation, again, 5.6. Used cars, that 10.5. That's not a surprise. Lodging away from home, up 7%. Other lodging, including hotels, 7.9%. Again, these are massive month over month changes, but we're still thinking those are mostly transitory. So as we look at it holistically, it's really why the market's having a hard time deciding, is inflation here to stay for the long run, or is inflation transitory? And you have these both sides battling, and the market is teeter-tottering. So when this data first came out, we actually didn't see a huge panic in the market. We actually saw the market start to rise. And then over the rest of the week, inflation fears started to pick up more and more, and we started to see more of a sell-off. So the market still is not sold that inflation is here for the long run, but I think we are starting to see more worrisome numbers. Now, the Fed did come out and say that, they are looking at, they're ready to manage. It is higher than expected, but they still believe it's transitory. But Jerome Powell flat out said, I'm not certain. I'm not certain it's transitory. We think it's transitory, but we're ready to make action if we need to. Now, personally, we don't think that the Fed is going to do anything until they really start to see the numbers later in the fall. So if we're waiting for September, October inflation data, that means we're probably going to have to wait at least until November to really see some big actions. So I don't think the Fed's going to start tapering until they know exactly where inflation stands. So maybe later in the fall, at the end of the year, we could see. But so far, the CPI data for June, not the direction we wanted to see. It is worrisome if we continue seeing this for the next 3-4 months. That's not a good sign. So we appreciate you spending the time with me this week. As always, we're here to support you. Your money's here to support you, and we'll see you again next week.